Good day, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Thursday. It's February 17th. The week is almost over. And boy, oh boy, it's been a really volatile week, but the market hasn't really gone anywhere. It's about 7:42. The market's going to open up in a little less than 2 hours, about an hour and 48 minutes or so. And as you can see here, the Dow Jones is down more than random. We had a pretty good upside yesterday. We closed near the highs. But right now we're down about 100 points, which is slightly below random or beyond random, if you will. NASDAQ 100 definitely beyond random, 76 on the downside. But again, the pre-opening doesn't really mean much because we have three major reports all coming out within the next 45 minutes. Housing starts, jobless claims, and Philadelphia Manufacturing Index. And these will do a pretty good job of shaping the market pre-open. Then we have James Bullard speaking, and I'll talk about the Fed in a little bit as well. Now, yesterday we had industrial production. On the industrial production month-to-month, we beat all expectations by a good margin. On the output, we didn't beat by a wide margin, but we weren't negative. We were just a hair under consensus. And under the capacity utilization rate, we were also above expectations. Now, that was a good report, but what was a better report, a real good report, and I'm crossing my fingers and my toes that it won't get downgraded or changed. Sometimes it gets revised, and as you can see here, revisions can go higher or lower. But look at the consensus on retail sales. And folks, retail sales makes up 2/3 of the economy. And if there's inflation, it's sure as heck not pointing its way into retail sales. Look at these numbers. These are good numbers. Two consensus, 3.8, 1%, 3.3, 0.6, 3.8. Those are really, really good numbers. And earnings have been better than expected too. So I'm actually looking for the market to do better than expected, to close this week better than expected. Now, keep your eye. We've got James Bullard speaking today. That's a Fed. We've got a lot of Fed data. Jobless claims is going to be important. Philadelphia manufacturing is going to be important. Housing starts, not as big because housing starts have been doing well to begin with. So even if there's a little cool off, it's not a big deal. What you want to pay attention to is this, and I'm going to tell it to you straight. I'm always a bottom line kind of guy. You want to keep your eye on the bond market. When this bond market starts going down, interest rates will stop going up, or perceived threat of interest rates going higher will stop. Because look, this is the 20-year plus Treasury bond. So it's pricing everything that's known into it as we will see it ahead of time. It's like a forward predicting proxy, if you will. So if we can get some choppiness or some upside from the bond market, we'll get a rally from tech, and it'll be an indication that stocks are no longer, that Fed is no longer going to raise rates. But right now, based on what we're doing and the way this is looking, if this continues moving lower, then the long-term flow is to increase rates. So as soon as you get a little reprieve here, maybe a little upside to the 140, 143 level, first of all, I'm going to sell this because the long-term trend is lower. Interest rate trend is higher, and this is inverse of rates. But, I think we're going to get cool off. I think this is too much too fast. We went from 155 to 135 in, let's see here, in 3 months, in 1 quarter. That's already pricing in a major rate hike. Let's talk a little bit about global economy, and it'll kind of solidify the things on our plate this morning. So the Fed, yesterday, today's Thursday, Wednesday, federal policymakers indicated they're leaning towards a more decisive action on inflation, but they haven't set a firm target date. You see here? That's the problem. We don't have a target date. And the market is already anticipating a fairly aggressive rate hike in its price right now. And we're only 2,000 points below all-time highs on the Dow. So you got to kind of look at that you got to look at all of these factors together. The prognosis is not that great. 7 rate hikes, no more aid from the Fed pumping money into the bond market, 40-year inflation, but retail sales are great. Some of the indications are really good. Some of the companies are doing really good. And folks, the biggest factor to drive stocks is earnings, and Fed data and retail sales. And retail sales is 2/3 of the economy. So I think the market may be overcompensating at this point already for all the information that is known. Fed meeting showed officials suggest a faster pace if interest rates would likely be warranted. Likely be warranted. You see that? They're very broad. Likely be warranted. No firm target date. The market's really aggressively anticipating them to make a move. So if they don't make a move aggressively, the market's going to rally hard. According to the Fed's notes, officials agreed at their January meeting that a faster rate hikes would be needed if inflation does not move down as the central bank's policy committee expects. As of December, Fed officials forecast inflation would fall from a four-decade high of 5.8% to 2.6%. Most analysts expect Fed officials to raise the forecast at their next meeting in March. But are they going to take action? On Monday, I'm going to tell you what's on my sleeve, Bullard, president of the Federal Reserve, St. Louis, repeatedly his call for the Fed to take aggressive steps of raising its benchmark rate by July 1st. We'll see it. We'll see. President of the Kansas City Fed expressed support for a more gradual approach. Mary Daly of San Francisco declined to commit herself to a more modest hike next month. Yeah, so it's kind of all very broad and very general, and no one's giving any specific dates. And meanwhile, retail sales surged 3.8% from last month's 2.5%. That's pretty crazy. And now, markets rallied Tuesday after Moscow said it removed some troops near the Ukraine border. Don't hold your breath. They're going to be playing this game for a while. But Western officials expressed doubt about it. Folks, I don't think there's going to be any war. I've been saying it for 2 months, and I'm still saying it. And believe me, a war is being priced into this market. So if there's no war, we're going to get a rally too. Russia is one of the biggest oil producers. Any military action that disrupts supply will jolt prices. And we'll talk about that in a minute when I give you my number one ETF, and it's related to natural gas. Now, looking at the stock market, energy, basic material, industrial were the top three. But look at four. Consumer discretionary, and I want to show you something else. This is my CSI scan. Look where technology is and look at where consumer discretionary is. Let me go back a week. Let's see here. It's stuck. I hate when it gets stuck. It's stuck. We'll get back to it right now. We'll get back to it. But the bottom line is both consumer discretionary and technology are moving higher. Now, let me look at those charts. I'll try to get the stock fetcher to work. Let's just see if it works here. Sometimes it takes forever to load. I don't know why. But if you look at consumer discretionary, and I've been really focused on consumer discretionary, we need to break above this level, and I think we will. And if we break above this level, this market's going to give us a nice juicy rally. So keep your eye on this level, the 186 level. Looking at the QQQ, the broad market, NASDAQ is still within this range, which means we're going to be choppier. But the highs, at least, the highs are getting higher. That's a positive sign. But till we break above the 200-day line, which is at the 367 level, there's going to be very, very action for us here. On the Dow, let me give you the Dow levels. On the Dow, we're almost there, but we need to break above the current level. We need to break above the 351 and hopefully break above the 355. And it looks to me like the market really wants to. So let's see if we can, if I could show you this graph here. Sometimes it works, sometimes it doesn't work, sometimes it works too much. So if as you can see here, energy, consumer staples, financial, technology is now number 4. A week ago, technology was also number 4, but look at consumer discretionary a week ago. It was second to last spot. It was on the 10th spot. Now, now consumer discretionary is on the 9th spot. Technology is still here. Let's go back a month. Technology was all the way down here, and consumer discretionary was up here. They were next to each other. But now they're diverting. Whenever they're diverting, the market needs to cool off and put them together. They need to trade next to each other. When you look at it on a monthly basis, technology is still the 5th spot, but consumer discretionary is going higher. And as I said, consumer discretionary. I know I keep talking consumer discretionary, but I'm telling you, folks, I know this like I know my name, and I know my wife's name. Right here, if we can rally above this level, we're going to be in a good spot, the 190.30 level on consumer discretionary. Doesn't look like it's going to hit this morning, but it may hit later in the day or before this week ends. But that's a major level that I need to break. Now, Today's Thursday, and I always give you an ETF and an option. And right now, I'm looking at natural gas. I've been looking at energy ETFs for a while. I think we're going to continue seeing pressure with Russia and Ukraine. This is a low-hanging fruit right now. And we also learned that a lot of the large hedge funds have been buying Chevron last quarter. Let's see where Chevron is. We see here, we see all the energy stocks: Devon, U.S. Marathon, Halliburton, ConocoPhillips. Where is Chevron? Really, I was actually surprised. So much buying Chevron. I'm sure it's here somewhere. There it is, Chevron. Yeah, it's like in the top 30th out of 500 stocks, so it's doing well. But this is a big buyer last quarter. The 13F filings are starting to come out. This was a huge buyer by Stanley Druckenmiller. I believe even Buffett has some Chevron. But Chevron was a big buyer last quarter, and look at all the energy stocks. So we're still looking at natural gas. Another good stock, a natural gas stock, is this APA. And let me give you an individual stock. Where is that stock? Pioneer, PXD, Pioneer Natural Gas, Apache, and here's an ETF, FCG, and I'll even give you an option with it, all right? We're going to go all the way to June, and we're going to go to the 20 strike price. There's not a lot of volatility on this thing. It's only about $2.30, $2.25, but 20 strike price, ticker symbol FCG, expiring in June. I really like that. And tomorrow we'll do an overview of the week, and I'll give you some major levels, and I'll also give you an update and what to expect for the following week. Now, folks, gap trading extraordinaire Mark A. Latimer and I, we just released an urgent broadcast on our 120 rebound strategy. Mark A. teaches me and viewers the nuts and bolts of this powerful approach to trading gaps. It's very cool. Gaps are pullbacks. It's just a form of pullbacks. What kind of a trader am I? I love pullbacks. Several of my programs are pullback programs, and some of them include the gap strategy, which actually is my most accurate strategy of all time, the tail gap, the Gilligan's Island in my VIP bootcamp. So I was skeptical at first, but she helped me overcome my questions about trading gaps consistently. And after seeing her remarkable results, I had to team up with Mark A to show everyone the power of the 120 rebound. Now, this broadcast could be the key to surviving volatility in these crazy, nutty markets, which could last for months. I don't want you guys to miss out on this. Follow the link below this video. Check this out and get in on this 120 rebound. At least watch the video. You're going to learn so much about pullbacks, about how to time gaps, how to find gaps. Mark K literally goes through her strategy and gives, I think, 3 or 4 examples, step by step, complete with entry, exit, and stop loss. It's a great way to trade these crazy volatile markets right now. You've got to follow the link below this video and check it out now. And if you have questions, comments, feedback, send them to me, support@marketgeeks.com. I want to hear from you. Bye, guys. Have a great Thursday. And keep your eye on housing starts, jobless claims, Philadelphia manufacturing. It's coming out in 30 minutes. Bye.